the relevant property types that the states would expect to see be reported. And remember, I'm telling you that, the states are getting savvy as to what lines of business you have, and they're going to be looking at what you're reporting. So the obvious, are your demand deposit accounts and checks. Your CDs, interestingly, as I've been here at Key now for 4 years running the reporting department, when we onboard banking clients, the one out-of-compliance property type that I see for a lot of banks is the certificates of deposit. And either they're being rolled over into infinity and never reported, or they're being reported under the wrong triggers. And I'll explain to you what a trigger means a little bit more later, but really it's what determines when that property is eligible for escheatment. And for certificates of deposit, there could be several triggers, several points that you have to take into consideration. It could be the maturity date, it could be the rollover date, it could be the earlier or greater of the two. So it's a little bit complex, and we see a lot of banks not making the right decisions in regard to the certificates of deposit. So if that's something that you have never reported to the state before, it really should be something that you're paying attention to, and seeking help if you need translation of the laws for how to report certificates of deposit. Other things like.
And I was going to say that property type is something that is typically on the radar of auditors. If you haven't been reporting it, they'll most likely ask you for records about it.
Absolutely, and keeping in mind that your CDs, sometimes can be very high dollar values. And if the auditors are being paid on a contingency basis for the money that they recover on behalf of the state, they're going to go after the CDs because they have higher dollar values tied to them in some respects. So a very hot topic in the world these days of unclaimed property. And, you can use this slide as a reference. I'm not going to read all of them to you, but some other products and property types that are under scrutiny these days are the IRAs and the educational accounts. The prepaid cards are also, things that need to be reported accurately and can be under scrutiny from the states. And then also the safe deposit box contents. States are very particular about what they'll accept or not accept with the state deposit boxes, and we'll get into some rules and regulations with them. But they are also a source of income for the states because mostly the items from the safe deposit boxes are being auctioned, and the states will retain the funds until such a time that the rightful owner comes forward. So in my experience, safe deposit boxes that I've seen in the state of Pennsylvania, 90% of them are junk, and 10% have really high dollar values, and the states are, auctioning on eBay or using private auctions in order to sell the items, A, because they don't really have a lot of space to store them, and B, because they're another source of revenue. So let's talk a little bit about, you've identified that you have these accounts, and you know that they need to be reported as unclaimed property. So where do you report them, and what's the laws governing where they need to be reported? So we call these in the world of unclaimed property the priority rules. Where does unclaimed property be, where is it reportable? And in 1965, there was a Supreme Court case of Texas versus New Jersey that kind of established the priority rules for the reporting of unclaimed property. And the first priority rule is the last known address of the owner of the property. So even though you may be located or incorporated in New Jersey, if you have an owner whose address of record is Pennsylvania, then the property should be reported to the state of Pennsylvania. When there is no sufficient mailing address, and that happens a lot if you've acquired another bank and the records were not good. You may just have Maureen Ferrari, Pennsylvania, or Maureen Ferrari 123 Main Street with no state. Those items where there's an incomplete address and no state identified go to the state of the bank's incorporation. So that's the second priority rule. And then the third refers to, states or entities that have no governing unclaimed property laws. So really kind of refers to our foreign account holders. So if you have a foreign address, then the property would go to the state of incorporation as well. So those are the three priority rules.
I was going to say that third rule is starting to be a discussion, and we'll talk about this a little bit more later, in how a state can with exemptions and exceptions. And if a state has an exemption, does that mean they don't have a law? And then that might trip to the state of Inc. And we're seeing that discussion happen. We've heard it happen, I should say, before the Uniform Law Commission's drafting committee. And I'll talk about that a little bit more later.
Thank you. And there are some exceptions to the priority rules, and the first one has to do with safe deposit boxes. And the safe deposit box, if it is located in the state of Pennsylvania, yet my address is in New Jersey, the contents of the safe deposit box will go to Pennsylvania. So the box is going to the state of location rather than the owner's state of residence. And money orders are also an exception, and they are reportable to the state of transaction. So let me just say something about the priority rules here, because another common, I wouldn't call it error, but really not a best practice that I see with some clients that we onboard for reporting services is that they say, yes, we've been in compliance, we're reporting everything to our state of incorporation, and they have reciprocal agreements with states, and the states are going to pay the other states their money that's due. And I think Karen can attest to the fact that, both of us being state administrators, there's really no formal reciprocity agreements in place among the states. And while they will accept some de minimis amounts of money, say you only have $10 or $100 to report to a different state, that they'll tolerate that going to the state of incorporation. But really turning over large amounts of funds to your state of incorporation that should go to the owner's state of residence is not a great practice for a number of reasons. One of them is you could be applying the wrong dormancy period. So you could either be over-reporting or under-reporting based on using the wrong dormancy period. It's also unclear to us, too, and the states, I don't know if they've addressed this, Karen, or not, but you can lose your indemnification because the property is not being reported to the correct state. And also, the states are required to send due diligence letters and also to some published in the newspaper, and for the foreign addresses or the out-of-state addresses, they may not make it into that due diligence population. So there's just a lot of reasons why that's not a good practice. And for me, never having lived in the state of New Jersey, I'm certainly not going to look on the New Jersey Unclaimed Property Office to find any funds that are due to me. So the chance that the money is going to actually be returned to your customer or the rightful owner are very slim when you do that. So that's just kind of a pet peeve of mine, and really a good reason to make sure you're reporting to the states of the owner's last known address. And the other thing
I might just add to that. I too feel like that it's a pet peeve of mine too. But I also would say that I honestly believe that when companies believe that they can and go ahead and report through reciprocity, that they could set themselves up for certain types of risks. You mentioned not having the indemnification, but you don't know when the other state's actually turning property over. That state's turning property over to the appropriate state, or if they're doing it at all. And if you're audited, it's a difficult audit trail when you've gone through reciprocity to show that the appropriate state's been paid. I've also seen where a state has gone back to a holder and said, look, well, that was all nice. That was nice that you paid this other state that ultimately paid us, but they paid us about 3 years after. You should have reported to us in the first place. So we need to rethink whether we assess penalties against you. So I really think that you may be setting yourself up for some type of risk, and possibly some type of audit risk when you report reciprocally.
I agree, Karen, and I think we've both seen it firsthand that there is no regular basis upon which the states reciprocate with each other, and it's probably done when they have time, and that time may only happen once every year, 2 years, or 3 years, depending on other, obligations and staffing and things like that. So it's really not a given that at a certain point in time every year a state's going to reciprocate. And there are some states that won't send money to states that don't send money to them. So it gets a little political there, too. So, best practice is to follow the priority rules. It really sets you up for having a good, robust unclaimed property program where you're, following all the rules and regulations to the letter of the law, and does eliminate some risk from your organization.
But before you move on, let me just mention one other thing. We had talked about the exceptions, which are the safe deposit boxes and money orders. Traveler's checks, too, are an exception. Both money orders and traveler's checks are an exception, and that's because of federal law, not because of state laws.